Imagine this. Your parents bought a house with just 3 years of their annual salary. No lottery, no inheritance, no crypto boom, no side hustle culture. Just a normal job, normal savings, and a normal loan. Now look at your generation. You are more educated, more productive, and living in a world that is supposedly richer and more advanced than ever before. Yet even after saving for years, cutting expenses and working longer hours, owning a home feels impossible. Not in New York, not in London, not in Sydney, not in Toronto, not in Beijing, and not even in cities that used to be considered affordable. So today, let's talk about something uncomfortable but unavoidable. Why is owning a home becoming impossible across the entire world? In this video, we will understand why houses used to be affordable for ordinary families, what fundamentally changed over the last 3 decades, how homes slowly transformed from basic shelters into global financial assets, who benefits from this system and who is getting crushed by it, and finally, what it would actually take to fix this crisis in a meaningful way. This is not a problem limited to one country or one political system. This is a global structural issue. For most of the 20th century, housing followed a simple and remarkably stable economic rule. A typical house cost around 3 times the typical household's annual income. Historical housing data from the OECD National Census records and long-term real estate studies show that in countries like the United States, the United Kingdom, Canada, Australia, and much of Western Europe, this ratio remained close to 3 for decades. That meant if a household earned the equivalent of $50,000 a year, a normal home cost around $150,000. It was not cheap, but it was achievable. Families saved for a few years, banks offered mortgages based on income rather than speculation, and people bought homes to live in them. Home ownership was not a luxury good. It was the foundation of middle-class security, stability, and long-term wealth building. Now compare that to today. Every year, Chapman University publishes the Demographia International Housing Affordability Report, one of the most respected and widely cited housing affordability studies in the world. It compares house prices and household incomes across 95 major metropolitan markets, including New York, London, Toronto, Sydney, Hong Kong, San Francisco, Los Angeles, Vancouver, and many others. The report uses a simple metric called the median multiple, which divides the median house price by the median household income. In a healthy and functional housing market, this number sits around 3. But in the most recent editions of the report, something unprecedented has happened. For the first time in the report's more than 20-year history, not a single one of the 95 cities studied is considered affordable. Across these cities, the average home now costs more than 5 times what a typical household earns in a year. In places like Hong Kong, the ratio is around 14.4. In Sydney, it is approximately 13.8. In Vancouver and San Jose, it regularly exceeds 10. And when you look at cities like Beijing and Shanghai, academic research, government-linked data, and independent housing studies show price-to-income ratios exceeding 20 and in some cases even 30. At those levels, buying a home is no longer a question of discipline or hard work. It becomes a mathematical impossibility for ordinary wage earners. And when housing becomes unaffordable, the consequences ripple through the entire economy. According to data from the World Bank, the OECD and national statistical agencies, people delay marriage, delay having children, and increasingly choose not to start families at all because they cannot afford the space and stability that home ownership once provided. Workers turn down better-paying jobs because moving to another city means higher rents and higher housing costs. Younger generations stop saving altogether because saving for something that feels permanently out of reach seems pointless. Entire cities start hollowing out from within. Teachers, nurses, construction workers, public transport staff, retail workers, and service employees cannot afford to live in the cities they keep running. Economists refer to this as a housing-induced labor market distortion, where high housing costs reduce worker mobility, lower productivity, and slow economic growth. So how did we get here? 30 years ago, this level of housing stress simply did not exist. The key reason is that houses used to be treated primarily as shelters. They were places to live, raise families, and build communities. Today, houses are treated as financial assets. Over the last few decades, not just homes, but land, stocks, bonds, and alternative assets like art and collectibles have exploded in price. According to Credit Suisse global wealth reports and data from the Bank for International Settlements, global wealth has grown much faster than the real economy, and a disproportionate share of that wealth has accumulated at the top. When wealthy individuals, corporations, and institutional investors get more money, they do not increase their consumption proportionally. They buy assets. Housing became the perfect target because everyone needs it. It feels relatively safe, it generates rental income, and it can be leveraged using borrowed money. As a result, trillions of dollars of global capital flowed into residential real estate, not to live in it, but simply to own it. At the same time, housing supply was being artificially constrained. Governments introduced zoning laws, height limits, minimum lot sizes, parking requirements, and long, uncertain approval processes. While many of these rules were initially introduced with good intentions, such as protecting green spaces or preserving neighborhood character, research from institutions like the London School of Economics, the Brookings Institution, and the IMF consistently shows that restrictive land use regulations reduce housing supply and push prices higher. Housing stopped behaving like a normal market. Prices no longer reflected the cost of construction, labor, or materials. They reflected policy-created scarcity. Then cheap money made the situation even worse. Central banks around the world lowered interest rates for decades in response to financial crises and slow economic growth. According to data from the Federal Reserve, the European Central Bank, and the Bank of Japan, borrowing costs fell to historic lows. If investors could borrow money at 2 or 3%, while property prices rose at 6 or 7% annually, owning housing became a near-guaranteed financial strategy. You did not need to live in the house. You just needed to own it. Institutional investors, hedge funds, pension funds, and real estate investment trusts began buying homes at scale. Research from the U.S. Federal Reserve and private housing analytics firms shows that in some American cities, institutional buyers account for a significant share of single-family home purchases. Foreign investors used property in global cities as a store of wealth. Speculation fed on itself. Meanwhile, wages stagnated. According to OECD data, real median wages in many advanced economies have risen by only around 10% over the last 20 years, while house prices in the same countries doubled, tripled, or even quadrupled. Dual-income households did not make housing more affordable. Sellers simply adjusted prices upward to capture the additional borrowing power. As prices rose, households took on more debt. Banks kept lending because rising prices made the system appear safe. Larger loans allowed buyers to bid higher, pushing prices up further and reinforcing the cycle. Then the pandemic hit. Construction costs surged due to supply chain disruptions. Labor shortages slowed building activity, and material prices rose sharply. Interest rates eventually increased to fight inflation. But housing prices did not crash because millions of homeowners were locked into ultra-low-rate mortgages and refused to sell. Supply froze. Governments tried to help, but often made the problem worse by offering buyer subsidies and tax incentives. Economic research repeatedly shows that when supply is constrained, demand-side subsidies simply push prices higher. So today's housing crisis is not the result of a single mistake. It is the outcome of restricted land supply, cheap money, wage stagnation, financialization of housing, and repeated short-term policy responses layered on top of a structurally broken system. The result is that the world's richest cities have become the least affordable places to live. According to OECD and national housing data, renters in many major cities now spend 30 to 35% of their income on housing alone, crossing the internationally accepted affordability threshold. The average first-time homebuyer is now in their late 30s or early 40s, nearly a decade older than previous generations. People stop moving for opportunity. Cities lose essential workers, productivity slows, inequality deepens. Existing homeowners gain wealth not through innovation or productivity, but through asset inflation driven by scarcity. According to global estimates, the total value of real estate worldwide now exceeds 3.5 times global annual GDP. So can this be fixed? Some countries are trying. New Zealand has introduced long-term land supply mandates. Cities like Minneapolis have relaxed single-family zoning. Singapore treats housing as public infrastructure and has achieved nearly 90% home ownership through large-scale public housing. Other governments are targeting speculation through higher taxes on second homes, investor restrictions, and limits on institutional ownership. The lesson is clear. We need more homes, but we also need to rethink who buys them, where they are built, and what role housing should play in the economy. Because at its core, this crisis is the same old story. Too much money chasing too few assets and crushing the middle class in the process. Now the real question is this. Do you think governments will actually fix the housing crisis, or will owning a home become a permanent luxury for future generations? Tell me what you think in the comments. And if you want more deep, evidence-based videos on global economics, power, and inequality, you already know what to do.